Hey everyone, thanks for joining us. I'm Bill Bourbonnais and welcome to today's Three Things Thursday. Now, Laura and I enjoy participating in our local Real Estate Investors Association, and we actually host our local subgroup meeting. The other day, I was talking with an investor who was really kind of frustrated that he couldn't deduct his rental losses against his very significant income from his daytime job. Now, he mentioned that his wife was reducing her work hours, and he wanted to know more about how that might be able to help them with their taxes and their real estate deductions. Now, if your real estate is throwing off losses and you can't seem to use them, you're not doing something wrong. You may just be caught in a trap that most investors don't know exists. So here are three things you need to understand about why your real estate rental losses are stuck and what it actually takes to unstick them. Thing number one, real estate rentals are passive activities by default, always. This is the foundational rule that drives all of this. Under the tax code, rental real estate activity is passive by default, every time. It doesn't matter how actively you manage it. It doesn't matter how many properties you own. The code says passive, and passive losses can only offset passive income. Not your W-2 wages, not your business income, not your investment portfolio, passive income only. If you don't have enough passive income to absorb the losses, they suspend, they carry forward, and they sit there until you do have passive income or until you sell the property. Now, Congress recognized this would be brutal for small landlords, so they built in a limited exception. If you actively participate in your rental, meaning you're making management decisions, approving tenants, setting rents, you can deduct up to $25,000 of rental losses against ordinary income each year. But there is a catch, like there always is with taxes. Your modified adjusted gross income has to be under $100,000 to get the full amount. Above $100,000, the allowance phases out at 50 cents on the dollar. So every $2 of your modified adjusted gross income above that threshold costs you $1 of allowance. It's gone entirely at $150,000. And here's the part that rarely gets mentioned. That $25,000 ceiling has never been indexed for inflation, not once since 1986. A lot of successful investors have quietly outgrown a benefit that Congress designed for them, and they didn't even notice it happening. So rental real estate is passive by default, and passive losses only offset passive income. There's a $25,000 exception, but most serious investors have already outgrown it. Thing number two, REPS is the gateway, REPS, and here's what it actually requires. Real estate professional status, REPS, is the mechanism that Congress created to break out of the passive trap entirely. It lives in Internal Revenue Code section 469C7, and it does one specific thing. It converts your rental real estate from passive to non-passive. Losses that were stuck can now offset any income, wages, business income, anything. But it's not easy to qualify. And here's where a lot of investors get into trouble, either assuming they qualify when they don't, or claiming it without the documentation to back it up. There are two tests. Both are required, no exceptions. Test number one, more than 50% of your total personal services during the year must be performed in real estate property trades or businesses in which you materially participate. Test number two, more than 750 hours of services during the year in those same real property trades or businesses are what you have to log. That 50% test is what eliminates most people who have a day job. If you work a 2,080-hour year, which is typical full-time hours, you need more than 2,080 hours in real estate on top of that to clear the threshold. That's a full-time commitment on top of a full-time job. Mathematically impossible for most W-2 earners. Now, for married filing jointly, one spouse must meet both tests on their own. You can't combine hours between spouses to meet the thresholds. And meeting the two rep tests is only the beginning. You still have to materially participate in each rental property individually unless you make a grouping election under the regulations. That allows you to treat all your rental activities as a single activity for the test. Most investors with properties should be taking a look at this election. If you're not, ask why not. But beware, once you make the election, it's irrevocable without IRS approval. One more thing REPS does that often gets overlooked, because your rental activity is now non-passive, the income it generates may be shielded from the 3.8% net investment income tax, which applies to passive income. That's a real benefit in profitable years. So again, REPS has two tests, both are required. 50% of your time in real estate trades and businesses, and 750 hours minimum in those businesses. One spouse alone for a married filing joint, and you still need material participation in each property. Thing number 3, what REPS doesn't do and what else you should know. REPS gets talked about like it's a master key. It isn't. Here's what it doesn't do. It doesn't help you if your rentals are profitable and you have no losses to unlock. The gateway is only valuable if there's something on the other side of it. It doesn't override basis limitations or at-risk rules under Section 465. If you don't have enough basis or enough economic risk in the deal, the losses are still stuck, just for a different reason. And your spouse being a licensed realtor does nothing to qualify either of you. Real estate license and REPS are completely separate analyses. One has nothing to do with the other. It also does not survive an audit without documentation. A contemporaneous hours log is not optional. If you can't show the IRS how you hit 750 hours and how that represents more than 50% of your working time, your claim fails. Reconstructing from memory after the fact, then you're in a very difficult position. Now, REPS is not the only path to solving some of the problems investors are trying to solve with it. Take the net investment income tax. If your rental activity qualifies as a Section 162 trade or business, it's treated as non-passive for net investment income tax purposes. The bar for Section 162 is lower than REPS, and it's a more accessible path for a lot of investors. But Section 162 status also opens the door to the qualified business income deduction, and this is where it cuts both ways. In a profitable year, Section 162 status can unlock up to a 20% deduction on your rental income. That's a real benefit. In a loss year, that same Section 162 treatment means your rental loss runs through as a negative qualified business income deduction, a qualified business loss, which reduces QBI from your other activities and carries forward to reduce future QBI. You don't get to choose which years it applies to. It follows the activity. The benefit and the obligation come together. Now, REPS is a powerful tool, but it's a specific tool for a specific problem. And it only works if you qualify, if you document it, and if you actually have losses worth unlocking. So in closing, rental real estate is passive by default, and passive losses are stuck until you have passive income to absorb them, or until you meet requirements that convert your activity to non-passive. The 25,000 exception helps some investors, and REPS can help others who can meet the tests. And there are other tools, like I mentioned, Section 162, grouping elections, cost segregation. These all work alongside or instead of a REPS, depending on your situation. What doesn't work is assuming that the losses will show up somewhere useful without understanding the rules first. If distinctions like this are helpful, 3 Things Thursday drops every week. I'm Bill Bourbonnais. Thanks again for joining us. Hit subscribe or follow below so you don't miss the next one, and have a great week. Thanks a lot.